All right, welcome everyone. Thank you all for joining us today at Metanym Risk's investor presentation and product demonstration. We are 2 past the hour and it looks like almost everyone's here, so I think I'm going to get going. All right, so my name is James Miongwi. I am the Chief Risk Officer of Metanym Risk, and on behalf of Metanym and the management team, let me welcome you once again to our investor presentation. We'll be doing a 30-minute presentation here, split into two 15-minute segments, one for the company and one as a product demonstration for Metanym's current solution. We have a further 15 minutes available at the end for a Q&A, so I'm going to ask if we can all hold questions until the very end for both segments, and then we'll address them all during the QA segment. So to get us started then, let me introduce Metanym Risk as a company. We are a pre-seed, pre-revenue startup founded in 2025 that provides institutional portfolio risk management solutions. We began work as a team in summer 2025. Over the last 6 months, we've developed now a very functioning, very effective risk engine and platform solution. We're now primarily looking for revenue through sales, but we are exploring equity investment to catalyze our opportunity. Our founding management team is made up of Josh Kwan, our Chief Executive Officer, Madi Zangane, our Chief Technology Officer, and yours truly, James Miongwi, our Chief Risk Officer. So as you can see here on our management bios, we've got over 2 decades of combined experience in institutional financial services, Josh specializing in supply chain, James specializing in risk management, both primarily on behalf of Bay Street banks. So a lot of institutional experience in the team. Madi brings to the team a decade of tech, data analysis, and software development experience. We've got a very strong team, and I'm only just slightly partisan in saying that, and that I've worked with these guys for more than a few months by now, and it's a very strong team that we have here. So let's talk a bit right now about the problem that we formed as a team to solve. As I think we can all say fairly, the world today is much more volatile than it was last year, 5 years ago, 10 years ago. And that this volatility, more than anything else, seems like it's going to continue into the near future. Certainly, I don't know anyone out there who's thinking that the next 3 to 5 years are going to get any more calm by any rate. In short, if you're betting on a return to a stable, predictable, calm world, this is not the play for you. If you are looking to alternative futures, I think we have some pretty good solutions on hand for a more volatile, more uncertain, more chaotic world. With the chaos in the news right now, as of the day that we're recording this, it was the recent events in Venezuela. By the time that you're watching this, who knows what the events will be? There's really no greater sign out there than the chaos of whatever's been going on, either when you're reading this or seeing this or right now, that we really need to adapt and we need to adjust to these changing times. It does kind of look like we're moving from a period of unipolar American global hegemony, for lack of better words, into a more multipolar, multi-chaotic, just crazy kind of world. That will require adaptment, that will require adjustment. That is where Metanym Risk comes in. Our flagship platform, the Metanym Risk platform, is unique in offering primarily qualitative portfolio risk management services. What are qualitative portfolio risk management services? I'll spare you the Oxford Dictionary defines it as, and let's use some examples. An invasion of sovereign territory and kidnapping a head of state is a qualitative risk. It's not the kind of thing that, as of yet, you can bet on with a quantitative edge. A terrorist group attacking critical infrastructure, more seriously, is a qualitative risk. There are any number of pipelines out there, deep sea data centers and data cables, vulnerable infrastructure all over the world, any one of which is vulnerable to a potential attack. a political movement that upends international geopolitics, in particular maybe leading to said aforementioned invasion of sovereign territory and kidnapping a head of state. That is a qualitative risk. A decade ago, I'm not sure that even the most forethinking of American political observers could really have expected to see where we would find ourselves in at this moment in time. Quantitative risk management focuses on the numbers. This is a good thing. Someone needs to keep track of the historic data. There's still a use for quantitative risk management. But in a chaotic, volatile, increasingly unstable world, that old buzzsaw about past performance not being indicative of future results is increasingly true, and not just about investment returns. I mean, ask yourselves, can you really, as investors, assume the upcoming macro environment is going to be anything like the last 40 years, or even the last 10 years? In uncharted waters, you need new ways to navigate. And that is where the Metanym Risk Platform comes in. Our risk platform provides the standard portfolio management services you'd expect. We track performance down to the individual security. We offer granular attribution of returns across funds, sectors. We make sure institutions have full reporting capabilities. But that is just the starting point for us. The Metanym Risk Platform innovates by tracking risk at the asset level, not the security level. For example, Apple has assets, headquarters, offices, factories. These are all buildings that have any degree of risks associated with them, not all of which are quantitative. Personnel, from senior leadership team, GMs of the aforementioned offices and factories. Intellectual property, the brand of Apple itself. All of those are assets. All of those face a unique set of risks, and not all of those risks are quantitative. That is where we come in uniquely as Metanym. As just two examples drawn from the air, what is the risk of a health scare involving the senior leadership team of Apple, supposing that there is a health outbreak some kind? What is the risk that a Chinese factory worker starts taking the principles of Marxist, Leninist, Maoism, communism, whatever seriously, and begins trying to form a trade union and shuts down work at an Apple factory? Those are risks. They are very real risks. But first and foremost, they are qualitative risks. You need someone out there who is interpreting the information around you. It's not just a matter of sheer numbers. Now, Metanym's risk platform, I'm not going to go into the full details about this. We're going to be covering this in a lot more detail during the product demonstration, but our core technology underpinning this innovation is the knowledge graph. So it uses a technology, an application of theoretical graph theory, that's a subset of computer science and mathematics. We, in short, create gigantic graphs that attempt to modular in exceedingly granular detail just what our various factors, securities are exposed to. The shorthand of it is, in the same way that Google built a giant knowledge graph of all the web pages they could track, and in the same way that Facebook built a giant knowledge graph of all the social connections they could track, so too are we at Metanym building a giant knowledge graph of all the risks we can track. We don't just offer look-back capabilities with our knowledge graph. We're also offering look-forward simulation explorations of the future. We take the knowledge graph at a given state in time and we say, here is the world as we understand it. What might 10,000, 100,000, or a million possible futures look like? What are the risks to your portfolio with those simulations? Now, admittedly, the market opportunity is small. Qualitative portfolio risk management is not the kind of thing that is on anyone's buzzword. Gartner does not track it. The closest that we were able to find is some interplay between enterprise risk management, GRC, supply chain risk, portfolio risk management. It's a new category, fundamentally. It has not yet been fully defined. There are a number of competitors we've identified. You can see some of them here. Archer Evolve, they have a pretty interesting risk compliance and simulation services, very similar to us. Logic Manager, they're doing about $20 million a year, mostly enterprise risk management, some analytics, some reporting. Then, of course, there is the elephant in the room, BlackRock. It's not that BlackRock does qualitative risk management, it's that BlackRock does everything. And in fact, their own geopolitical risk indicator dashboard was a influential factor, we'll say, in shaping our own strategic vision of this company. For that reason, we are not assuming a market size anything larger than $1 billion a year. We're taking a very conservative approach towards the total addressable market as we understand it, knowing that qualitative portfolio risk management is not yet a category. We are also taking a very conservative approach towards our strategy. The reality of the marketplace out there is that we will not be able to effectively compete against any of these businesses should they choose to turn their attention to qualitative risk management. For that reason, we are a cash acquisition play. I will say again, the primary purpose of Metanym Risk is to be acquired for a very large sum of money, the majority of which should be cash. Should we have outside investors, the secondary objective will be to earn a 10-time return for our investors at a valuation of $5 million or more. These are structural constraints imposed upon us by the reality of the marketplace. It is what it is. Let's make the most of it. In the short term, what we intend to be doing. Our milestones, as you can see here, we're going to be hiring a salesperson this quarter. We are going to be incorporating this quarter, and we are going to be launching the Metanym Risk platform in Q2. Probably closer to the end of Q2 than the beginning, but cross that bridge when we get to it. As you can see here, there is no necessary indication that we will have outside investors. However, we do have a very strong interest in having outside investors contribute to a seed funding round should there be complementary skills available to those investors and a degree of mutual alignment on the goal of a cash acquisition play. The founding team has creativity, we have drive, we have initiative, we've made a very impressive product. I don't shy away from saying that. However, there are any number of gaps out there where we could stand to benefit significantly from having experienced investors with good judgment, good wisdom, who are able to provide useful strategic advice for what we should be doing as a company. That is our primary interest. Money can be found anywhere, but the right kind of human capital, as contrasted with merely just financial or cash capital, that is what we are most interested in pursuing, a mutually beneficial relationship with investors who are able to not only contribute their funds, but who are able to contribute their expertise, their judgment, and their experience in service of a mutual goal of let's make a lot of money and let's make it in the next 3 years. So, this concludes the investor presentation. We are a little ahead of time, so I'm going to break for a moment or so, wet my throat, and then we're going to come right back in for the product demonstration. So give me just a minute or so here. I'm going to go on mute, and then I will be right back.